Let's move on to the banks ahead of Fed Powell's speech a little bit from now at Jackson Hole. Gerard Cassidy is RBC Capital Markets co-head of global financials. He joins us now. I mean, generally, when I look at, J.P. Morgan, Gerard, or Bank of America, or Citi, Goldman Sachs, pretty good years for the stocks. As we get ready potentially for rates to decline, are we going to see any significant response from these banks?
David, it's going to be interesting because, as you pointed out, many of these stocks have had good years so far. Year-to-date performance generally for the banks has outperformed the Standard & Poor's 500. And so I think what the stocks are doing is they're anticipating that the Fed will cut rates. It will be beneficial to the banks, and we'll start to see an improvement in their revenue growth as loan demand comes back in the economy that many of us expect to be a so-called soft landing. So if you go back in time and you look at a last time, or the only time I think in our careers that there was a soft landing, it was 1995. And in that year, the bank stocks already moved in the beginning of the year, but they were up 55% in 1995, best performing sector in the S&P that year because of the soft landing and the expectations going into 95 that there was going to be a recession, which never showed up. So I don't expect that kind of dramatic increase, but they should continue to outperform if we do get the Fed to cut rates and we do have a soft landing.
Yeah. And where are you in that camp? You a believer then, and therefore a believer that there's more upside for many of these big banks?
We are a believer, David. And I think the reason being is, though the employment picture has softened a bit, employment is still very healthy. The unemployment rate at 4.3% thereabouts is still a strong rate relative to history. Now, relative to recent history, of course, it's higher. But these are strong levels. The consumer balance sheet is in good shape, as are most corporate balance sheets. And like I said, if the Fed does start to cut rates, generally, that's been positive for the net interest margins, which have been a challenge to the banks.
When Trump's odds were going up a few weeks ago after the debate, after the assassination attempt, the banks were rallying, and people were saying because of the odds of a Trump and red sweep would be good for banks and deregulation. Is the election a swing factor now that things are looking a little more even in the polls? Does this matter for banks ultimately and what we expect from Basel III and everything else?
Sarah, it's an interesting observation because you're right. After the debate and then the assassination, obviously Trump definitely had an upswing, and there was the Trump factor in the banks, as you described. And it was very dramatic when he won back in 2016 because of the deregulation and as well as cutting tax rates. And even if he was to win, and it's a hard one to call, of course, it just won't be as positive as his past term, but it would be more positive than the current administration, who's kind of held back on a number of areas, particularly when it comes to mergers and acquisitions. But you brought up something else quite interesting, which is Basel III Endgame, and that is a critical regulatory piece that needs to be finalized. It came out in July of 23. Everybody pushed back on it. Now what's happening is we think they're rewriting it. We'll get a new proposal, which will be less onerous for the big banks. And once that comes out, maybe we'll get it before the election, just the new proposal, not the implementation. And then the banks can really have an understanding of what kind of capital they need. And we expect very strong stock buybacks because the banks are very well capitalized once we see that final plan.